Hey, it's Vince from LifeSherpa here. Now, there's been a lot of commentary in the media around what's been happening in global markets recently. So I'd just like to jump on here and provide a little bit of colour and context and some clarity about what's happening and what you should be doing about it. So what's actually happened? Well, the Australian share market, as measured by the ASX 200, is down 2% on Friday and 3.7% yesterday, Monday. And the futures this morning, Tuesday, are indicating it's likely to be another down day. In the USA, the S&P 500, the largest 500 companies in the country, is down 3% for a total fall of 8.5% from its July 16th high. The Nikkei 225 in Japan is down 18% since the start of August. And Bitcoin is down 18% since July 29th, giving up all of its growth since February. So, why is all of this happening? Well, there are a number of factors that have come together to create this sort of short-term volatility. In the US in particular, the froth has come off the AI boom, with Nvidia down 26% from its June high. US unemployment came in a little higher than expected at 4.3% last week, despite non-farm payroll rising by $114,000. This was less than the market expected, and it created a heightened fear that the US might be heading into a recession, and increasing expectations that the Federal Reserve, the US Central Bank, might cut rates, and that in turn pushed the US dollar lower. At the same time, the Bank of Japan was lifting rates, ending an era of practically zero Japanese interest rates. And these three factors together signal the end, at least for now, of what's known as the Japan carry trade. That's a pretty obscure term, but this is what it means. It means that investors have been borrowing in yen in Japan, almost for free, and investing it in the USA at much higher returns than they could get in Japan. This worked really well when the yen was consistently falling, and those loans could be repaid with fewer US dollars than they were worth when taken out. The yen has fallen almost consistently for the past years, falling a total of 26%. Falling US interest rates and rising Japanese rates have pushed the yen up 11% in a month, back to where it was in January. So, falling US share prices force these investors to sell to meet their margin calls, further fueling share price falls. While at the same time, the cost of their Japanese debt has doubled, making it harder to hold on. And the rising yen means they need more dollars to repay the loans. Back home in Japan, investors are concerned that their banks may be in trouble if these loans can't be repaid. So this leads to falls across the globe, and of course Australia is not immune. So that raises the question, should I be doing something about it when it comes to my investments and my super? As a general rule, I'd like to say no, and a little perspective will help understand why. So firstly, the ASX 200 is back where it was in May, and still up 12% on the 12 months, which makes those 12 months an average 12 months as far as the Australian share market is concerned. The Nasdaq and the S&P 500 in the US are back where they were in May. The S&P 500 is up 15% for the year, and the Nasdaq is up 17% for the 12 months. Gold remains at an all-time high, reinforcing its value to Australian investors. And of course the Australian dollar is down slightly, cushioning the value of overseas assets. So no, this is not a time to sell. Nor is it necessarily a time to buy. The Reddit tech bros are all yelling that the market is on sale and you should buy with your ears pinned back. But ask yourself, why weren't they saying the same thing 6 weeks ago when the market was at the same price? And this is where aligning your portfolio with your risk profile really matters. These movements might seem dramatic given the media coverage. We've just been through one of the most benign decades in stock market history with low inflation and high growth. And if you don't remember 2008 or 1987, it can be easy to be lulled into a false sense of security. In 1987, stock markets fell 30% over a few days and kept falling. And in Australia fell more. That's what a true crash looks like. And I can tell you from first-hand experience, it's scary when you've never seen real blood in the streets before. But this is not 2008, nor is it 1987. And in truth, pullbacks are relatively common, but they do make for good headlines. Falls like we've seen recently happen quite frequently, with global share markets experiencing. But in truth, pullbacks are relatively common, even if they do make for good headlines. Falls like we've seen recently happen frequently, with global share markets experiencing a 10% or higher pullback every other year on average. And the S&P 500 has on average risen 8% within 1 month of its bottom, and more than 24% within 12 months of those bottoms. So what should you do instead? Well, you need to remember that this too shall pass, and it's time to stick with the plan. I don't know what markets will do tomorrow, nor do economists or newspaper journalists. But generally, the best days in the market are often very close to the worst days, so now is not a time to panic. Could it get worse? Of course it could. Will it? Nobody knows. So focus on the plan, not the portfolio. If it was right for you yesterday and your plan hasn't changed, neither should your portfolio. So stay the course.